Andrew Gibson is Head of Research at Faraday Research. He's with us, as is Valentine, who is with us, of course, from ING Investment Management. I brought up the 3D because I wanted to segue into some of your stock picks, actually. I thought it might be useful to pick out some individual companies here just to try and support the argument that you've been making. Yeah. So DDD Group is a business that turns 2D into 3D on screen. Tell us a bit more about why you like it.
I think that 3D is the next step in a lot of these electronic devices we're all buying. Televisions is the first one. They've already captured about 3D televisions are due to be about 9% of the global market this year, 22 million units. So it's growing fast. And Triple D is the market leader at computer chips that turn 2D images into 3D images. So televisions is the first device, mobile phones, laptops and tablets. They've done deals, licensing deals with Sony, Samsung, Hewlett-Packard, Texas Instruments, Advanced Micro Devices. So all the big names are signing up to 3D's technology. So it's not just television. It could be things like videos on YouTube, your photo albums, games are a massive thing, and films. And you don't need to wear the glasses, that's the key.
You don't need to wear the glasses?
You don't need to wear the silly glasses.
Well, that's something. Pennon Group, let's move on to this. Water business. Tell us a bit more about why you like it.
Well, it's really, again, as I was saying, at the other end of the market, something that's dull, dependable. People want inflation protection right now in what they invest. Pennon Group have a dividend policy that's RPI plus 4%. Until 2015. So that is effectively almost like an inflation-protected bond with some growth added in as well.
Do you see in these stronger companies any inclination to become a bit more willing to invest in the future? Because I think one of the things that is obviously missing is that even the stronger parties out there, the strong balance sheet, the strong growth prospects, these companies are also focusing on cash and are very reluctant to actually invest in growth.
They're hoarding cash. That's due to a lack of confidence. M&A is very thin on the ground. That's why we're also seeing pretty poor numbers coming out of the investment banks.
So what will make that change for them?
I think that they need to have some better visibility about where we're going economically. And at the moment there's a lack of credibility with governments around the world dealing with their deficits. So until the credit markets start to calm down, I can't see CEOs doing anything other than hoarding cash and protecting their balance sheets.
OK, gentlemen, come back to the conversation in just a moment. Steve, I'll send it back to you. Well, fascinating conversations, and Andrew, I think since you've sounded slightly more positive, maybe we can bring up the bank share issue with you. Steve was talking about extension of short-selling bans in France, some other issues with banks that are now starting to confess their exposure to sovereigns. I think you like the senior bank debt. Anything in the banks you like at all?
No.
Nothing?
No. I think the problem when you invest in the banks is there's no visibility. Even when we didn't have this credit situation now, we still had a lot of regulatory risk. And so the moment the banks have any sort of health, the governments are on them to try and take money away from them through special taxes or new regulations. It's a situation where things are good, they get hit. Where things are bad, they're obviously getting hit. So, no, we don't like the financials.
I mean, we tend to agree absolutely with respect to the equity sector. We're underweighting financials, and I think, to a large extent, they have secular pressure on their profit models. And next to that, they are most exposed to the biggest tail risk out there, the euro sovereign crisis. On the fixed income side, we like senior bank loans. But of course, through those loans, you have basically, special governance, and you don't have exposure on the banks themselves. It's more sort of a debt structure. In current environment, you also see this in the high yield market. You're getting really attractive spreads in an environment where still balance sheets are strong and defaults are amazingly low.
You made an interesting comment off-air as we started the conversation this morning about how it feels a bit like we're back in 2008, where we're watching the bond markets to give us guidance on investing in equities. What else to you feels like 2008? Surely we're not revisiting the global financial crisis.
Well, only that I think in 2008 we didn't solve the problems, did we? We just transferred the risk from the banks to the governments, and we, I think a lot of people could see that was only a matter of time before the problems resurfaced, and here we are again. And really, there's still too much debt in the world, and that's come to the the surface again. It really was just a matter of time before we were back here again. And as you pointed out, you tune in each day as someone that trades the stock market, and really you need to be tuning into what's happening in the credit markets to get any sort of guidance as to what's going on in the stock market.
Yeah, I mean, this is just another chapter of the same crisis, and that's the way we read it, and probably we're going to have to read through another couple of chapters before we can finally finish the book. And this will go on for some time, and everybody is scrambling to find a solution, and we haven't solved it. Yes, I agree, but also we were talking, you know, it's quite difficult to find a solution now, and there's differences of opinions there where, you know, for example, some people are arguing for aggressive further government cuts right now, and other people are arguing for the government to basically, you know, give some guidance, referring to corporate leaders as well, looking for governments and solutions before they become more constructive in their willingness to spend and hire.
Mm-hmm. So where do you still favour in terms of geographical markets at this point?
I mean, we focus on the UK market, but admittedly in the FTSE 100 I think it's about 2/3 of the earnings come from abroad anyway. The overall theme is still the same. You know, history tells you that wealth is always transferred from debtor nations to creditor nations. That's still going to happen. It's a well-worn theme, but emerging markets is still going to be where the growth's coming from. But the FTSE 100 still has a lot of exposure to emerging markets as well.
Okay, it's been good talking with you, Andrew. Thanks very much for coming in. Valentine, you're going to stay with us, so we'll pick up the conversation a little later on. Andrew Gibson, Head of Research at Faraday Research.